We're here this morning talking Primary Health Properties, and with me I've got Capital Network analyst Ed Stacey. Ed, good morning to you.
Good morning.
And a reminder, for Ed's full report, do click on the eye on the top right hand corner of your screen. Ed, first off, Primary Health Properties PHP, tell me a bit more about them.
One of the first observations, and it's one of the main reasons people invest in the REIT space, real estate investment trusts, is a steady growing dividend stream. And PHP really delivers this. They've increased the dividend every year since they listed in 1997. So a very long track record of increasing dividends. And that is all underpinned by rental income that they receive from one of the safest asset classes in real estate, primary health properties, which means doctor surgeries and things like that. And examples of how this is such a very safe asset class: 90% of the rents are government backed. They have 99%, more than 99% occupancy rates, and the average remaining lease time unexpired on their portfolio is more than 13 years. So some metrics to tell you about very safe asset base underpinning that dividend stream.
So Ed, you talk about the safe rental revenue stream there. How does that convert? How does that map into, if you like, the profitability?
Yeah, well, that's all about cost efficiency. And we look at that in terms of the cost ratio, meaning their costs incurred proportionate to the amount of rent they received. And they compare favourably, in fact, most favourably, in the UK REIT sector. They have the lowest cost ratio of anybody. And that's actually improved even slightly thanks to the merger they did with MedicX back in March. You remember a big merger. That's a lot of advantages coming out of that merger, but in particularly the cost efficiency improving even beyond what it was before. So yes, the cost efficiency a big factor in converting rental income into net profit and therefore into dividend.
I just want to pause for a moment on one thing that you said there about the safety of the income stream. Are we talking about lower risk and hence lower reward here?
You would think so, but in actual fact, over the last 5 years, PHP has outperformed the FTSE 350. It's a FTSE 350 constituent. It's also outperformed the UK REIT sector, and it's something we've analysed in this report. How have they done that on such a safe asset base? And simply, it's that you can get a very satisfactory rental return on these medical properties, and without some of the costs and the pitfalls that affect the wider REIT space, and then that low cost base, converting it nicely into profits. So it's been a very strong performing investment as well as being safe.
So a strong performer. What's the outlook like in the next couple of years then for them?
Going forward, we very much expect more of the same. This is really one of the easier companies to forecast, given the visibility on the rental income. And by our forecasts, we have dividend continuing to increase again in 2019, 20 and 21, and that dividend well covered by growing earnings as well. And we're not assuming anything there spectacular in terms of, post the merger with MedicX, is there some big acceleration in the portfolio acquisition stream or something like that? No, we're just really assuming continuous progress, and that delivers you your growing dividends, and that should keep the share price ticking up nicely as well.
Ed, good to get your thoughts. Thanks very much.
Thank you.
And for Ed's full report, do click on the eye on the top right hand corner of your screen.